Now, despite sentiment that central bank would raise the CBR rate, it maintained the rate at 6.75. What are the immediate impacts, and why do you think the central bank maintained it that way?
Thank you, Terry. You know, the MPC gave reasons why they maintained the CBR at 6.75. But what we glean from the reasons they gave is that it seems that the reduction of the CBR rate is working, in that it gives a direction to the financial sector that the direction the interest rate should be going based on the central bank perception. And the central bank prefers the interest rate to be depressed, and we are seeing it working because the interest rates have been going down. The market interest rate for most treasury bonds have been going down, and therefore perhaps central bank felt that there is some more room to go down for interest rates to be further depressed. Hence, they maintained it that way.
Let's look at some of the recent activity on the fixed income front. The 5-year Treasury bond was recently launched with a no coupon rate. What are the immediate impacts you expect from that particular bond offer?
First of all, it was not no coupon. What happened is the coupon was left to be determined by the market. Mm-hmm. Previously, what central bank used to do is that they assign a coupon rate for every issue. And what normally used to happen is most banks found their coupon rates determined by the central bank to be a bit more attractive. Mm-hmm. What the central bank decided to do is to probably let the market determine the coupon rate, whereby the average becomes the coupon rate. We have seen that help in reducing interest rates, and it helps the central bank in one way, because central bank is able to borrow much more cheaply, much more affordable cash. And on the other hand also, because of that, interest rates have been declining in the market, and most financial institutions are beginning to prefer to lend out to private sector.
Mm-hmm. And that's exactly what the central bank governor, of course, has been pushing for, that the commercial banks begin to lend to the private sector. How's the private sector reacting to the current lending environment?
We have seen in the market quite a number of banks have been reducing their base lending rates. The fixed income segment, which is has been preferred by the market players due to who are risk averse. Mm-hmm. We are finding the rate of returns declining. Mm-hmm. And hence they are compelled to go out to the private sector, where they probably will get a little bit better return. So it seems to be heading in the right direction based on central bank perspective. And
how's the fixed income market currently responding to the rise on the equities front?
Fixed income has been steady so far. Mm-hmm. We're still seeing levels that are much more higher than same time last year. But the players are still there. We're seeing banks still preferring it because of its relatively less risk than equity market. So it's still significantly higher. Like, for example, yesterday fixed income recorded 1.7 billion, whereas equity recorded about 200-300 million. Mm-hmm. So still fixed income is a bit more preferred now.
Okay, going forward, your expectations after this 5-year Treasury bond that has just been launched, are we expecting any corporates?
Corporate bonds, maybe, depending on this is a very good time for corporates to come and borrow, because interest rates are a bit lower. Also, the debt market, there is some competition between bond market and outright lending from banks. Mm-hmm. So we are yet to see how that plays out.